There is a promise that lives at the heart of the financial world. It's a quiet promise, often drowned out by the shouting heads on television, the frantic scrolling tickers, and the breathless hype surrounding the next world-changing technology stock. The promise is not one of explosive, overnight riches. It's not about finding the one lottery ticket that will transform your life in an instant. It's a deeper, more profound, and infinitely more valuable promise. It's the final promise an investor can make to themselves. The promise of survival. The promise that the capital you have worked so hard to accumulate, the savings you have painstakingly set aside, will not be vaporized by the whims of an irrational market or a single catastrophic mistake. This is the promise that underpins all true wealth creation. It's the foundational rule of the man who has become synonymous with investing success, Warren Buffett. His first rule is famous: never lose money. His second rule is equally so: never forget rule number 1. But what is often missed is that these are not just folksy sayings. They are the output of a single powerful operating system. A mental framework so robust that it has guided him through more than half a century of panics, crashes, and manias, allowing him to not just survive, but to compound capital at a rate that has become the stuff of legend. The secret isn't about winning. It isn't about being the smartest person in the room or having a crystal ball. The secret, the core of this entire system, is a simple, elegant concept known as the margin of safety. It is the deliberate act of buying $1's worth of a business for 50 cents. It is the discipline to build a buffer, a moat of protection around every single financial decision you make. This is not a strategy for avoiding risk. That is impossible. This is a framework for managing it so effectively that even when you are wrong, you are unlikely to get hurt, and when you are right, the rewards are magnified beyond measure. Today, we are not just going to talk about this principle. We are going to dismantle it, reverse engineer it, and build it back up from first principles so that you can install it as your own core operating system. This is the journey from speculator to owner, from gambler to investor. This is the path to making that final, most important promise to yourself. The bedrock of this entire philosophy, the single idea upon which Warren Buffett's empire is built, is the stark and unwavering separation of two concepts that 99% of market participants confuse every single day: the concept of price and the concept of value. To the average person, the price of a stock embodies its value. They are one and the same. If a stock is trading at $50 a share, then it is worth $50 a share. This mental shortcut, this seemingly harmless assumption, is the single most destructive error in all of finance. It is the open door through which fear, greed, and catastrophic mistakes enter your financial life. Buffett, taught by his mentor Benjamin Graham, understood that a company's stock price is merely a reflection of the market's mood on a given day. It is a poll of popularity, driven by headlines, emotion, and short-term sentiment. The company's intrinsic value, however, is something entirely different. It is an estimate of the true, underlying worth of the business, the discounted value of the cash that can be taken out of it over its remaining life. The price is what you pay. The value is what you get. The margin of safety exists only when you can get far more value than the price you are asked to pay. There is no story that illustrates this principle more powerfully than Buffett's transformative investment in American Express during the darkest days of the Salad Oil scandal. The year was 1963. American Express was a blue-chip institution, the very picture of financial stability. Its travelers' checks were a global currency, its credit card a symbol of affluence. The company was a core holding for trusts, widows, and orphans. But deep within one of its smaller, more obscure divisions, a rot was festering. American Express had a field warehousing division. The business was simple. A company could put its inventory in a warehouse managed by American Express, and in return, American Express would issue a warehouse receipt certifying that the inventory existed. That company could then take the receipt to a bank and get a loan, using the inventory as collateral. It was a mundane, profitable business built entirely on trust. The problem was one of their largest clients in this division, the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic and cunning fraudster named Tino DeAngelis. DeAngelis had discovered a loophole in the system. His warehouses were filled with massive tanks, supposedly full of valuable salad oil, but most of the tanks were actually filled with water, with only a thin layer of oil floating on top. When inspectors would dip their sticks in to check, they'd come up coated in oil. He was using forged and duplicated warehouse receipts to secure hundreds of millions of dollars in loans against oil that simply did not exist. In November of 1963, the music stopped. Allied Crude Vegetable Oil filed for bankruptcy, and the staggering scale of the fraud was revealed. The company was on the hook for an estimated $60 million in losses from the bunk collateral, a massive sum at the time, equivalent to nearly the entire net worth of American Express. Wall Street panicked. It was a bloodbath. The narrative was simple and terrifying. American Express, the bastion of trust, had been duped. Its reputation was in tatters. If they couldn't be trusted to verify barrels of oil, how could their travelers' checks be trusted? The herd mentality took over. The stock, which had been trading at over $60 a share, plummeted. Day after day, it gapped down, falling by nearly 50% to a low of $35. The price was screaming, disaster. The experts, the analysts, the talking heads, they all agreed the company was finished. This is the moment where the path of the 99% diverges from the path of the master investor. While everyone else was looking at the falling price and feeling the terror of the scandal, Warren Buffett was asking a different question. What is the business actually worth? He ignored the price ticker and started his own independent investigation. He didn't build complex spreadsheets. He did what he always does. He went out and talked to people. He visited restaurants and banks. He spoke with merchants and travel agents. He stood in line and observed customers buying travelers' checks. He was trying to determine if the scandal in the tiny warehousing division was having any real impact on the two crown jewels of the company, the credit card business and the traveler's check business. What he found was the complete opposite of what the stock price was telling him. Diners were still using their American Express cards. Travelers were still buying travelers' checks with unshakable confidence. The merchants he spoke to confirmed that their American Express business was as strong as ever. Customers didn't care about salad oil in New Jersey. They cared about the convenience and security of the brand they had trusted for decades. The scandal was contained. The core business, the real engine of value, was unharmed. Buffett then did the simple math. He conservatively estimated the earning power of the traveler's check and credit card businesses. He concluded that, even after accounting for the full $60 million loss from the salad oil fraud, the underlying business was worth at least $65 per share. The market, in its panic, was offering to sell him this $65 business for just $35. He had found his margin of safety. He famously invested 40% of his partnership's assets, $13 million, into American Express stock. It was a massive, concentrated bet. Over the next few years, as the market's panic subsided and the company's powerful earnings continued to roll in, the stock price recovered and then soared, eventually tripling. This single investment was a cornerstone of his early fortune, a masterclass in separating market sentiment from business reality. The psychological forces that create such an opportunity are incredibly powerful and deeply ingrained in our brains. The first is anchoring bias. When the stock started its plunge from $60, every new lower price became the new anchor. An investor seeing it at $45 thought, wow, it's down a lot, but it could go lower. When it hit $40, the new anchor made $45 seem expensive. The falling price itself became the narrative, blinding investors to the fundamental value of the business, which hadn't changed. They anchored to the market's fear, not to the company's financial statements. The second, and even more potent force was herd mentality. In times of uncertainty, our brains are wired to look to the crowd for safety. When everyone is selling, the instinct to sell becomes overwhelming. It feels safe to be part of the herd, even if the herd is running off a cliff. to stand apart, to buy when your friends, your broker, and every newspaper headline is telling you to sell, is an act of profound intellectual and emotional courage. Buffett was able to override these biases because his mental model was different. He was not a renter of stocks, he was a buyer of businesses. This brings us to the blueprint, the applied mental model that you can use to emulate this thinking. It's called the business owner test, and it's a simple, powerful way to reframe your investment decisions. The next time you are tempted to buy a stock, I want you to perform this three-step process. First, completely ignore the stock ticker and its daily wiggles. Go to the company's website and read its annual report. Your only goal is to answer one question in a single, simple sentence. How does this business make money? If you can't do this easily, you shouldn't even consider investing. Second, find the company's total market capitalization. This is the total price for the entire company. Ask yourself this critical question. If I had that much cash in my bank account, would I, right now, write a check and buy this entire company, taking it private to own it all for myself? This is the ultimate test. It forces you to move beyond the abstract idea of a share and into the concrete reality of ownership. Suddenly, the question isn't, will the stock go up, but is this business, in its entirety, a good deal at this price? Third, you must write down your reasoning. Why would you buy it? Is it because of its strong brand, its growing profits, its dominant market position? Or why wouldn't you buy it? Is it because it has too much debt, faces too much competition, or its future is too uncertain? This simple act of writing it down forces clarity and exposes flimsy reasoning. If you wouldn't be willing to buy the whole company, why on earth would you be willing to buy a small piece of it? This mental model is your primary defense against the destructive path of the 99%. The path of the 99% is the path of the story stock chaser. This investor doesn't buy businesses, they buy narratives. They hear about a revolutionary new technology, a disruptive business model, or a charismatic CEO, and they fall in love with the story. They see the stock price soaring, fueled by media hype and social media chatter, and they feel the intense pressure of FOMO, the fear of missing out. They buy the stock not because they've analyzed its earning power or balance sheet, but because they believe in the story and they see the price going up. The problem is that stories can change in an instant. A hot tech company might miss its quarterly earnings projection. A competitor might release a better product. A key government regulation might change. When the narrative breaks, the stock price collapses because it was never tethered to any underlying business value in the first place. The story chaser is left holding the bag, having suffered a permanent loss of capital from which it is very difficult to recover. They bought the sizzle, not the steak, and learned the hard way that in investing, price is a liar, but value, eventually, is the truth. The direct financial connection of adopting this price versus value mindset is profound and immediate. It fundamentally alters your approach to asset allocation and risk management. Instead of a portfolio filled with a random collection of popular stocks, you begin to think in terms of two distinct buckets. The first bucket is the investment bucket. This contains only those businesses that you have analyzed, that you understand, and that you were able to purchase with a significant margin of safety. You have a rational basis for believing that the value you received is far greater than the price you paid. The second bucket is the speculation bucket. This is where you might place a small, strictly limited amount of capital on things that don't pass the business owner test, perhaps a promising but unprofitable biotech company or a cryptocurrency. By explicitly labeling it speculation, you acknowledge the higher risk and prevent it from corrupting your core investment philosophy. For most people, their entire portfolio is in the speculation bucket, without them even realizing it. Adopting Buffett's foundational principle of separating price from value is the first and most critical step in professionalizing your wealth management. It builds a firewall between rational business analysis and the emotional madness of the crowd. It is the cornerstone of capital preservation and the starting point for building true, lasting financial freedom. Without this, all other financial education is useless. It is the beginning of wisdom. Once you have accepted the fundamental truth that the price of a stock and the value of the underlying business are two completely different things, the next logical question becomes, How do you determine the value? This is the second great pillar of the margin of safety framework, the art of conservative valuation. It is here that many aspiring investors get lost. They believe the secret lies in mastering complex financial models, in building intricate spreadsheets with dozens of variables projecting earnings out to a decimal point a decade into the future. They believe that the more complex the model, the more precise and therefore the more accurate the valuation will be. This is a dangerous illusion. Buffett's approach to valuation is, in fact, the opposite. He believes it is far better to be vaguely right than to be precisely wrong. The goal is not to pinpoint a company's intrinsic value to the penny, but to arrive at a conservative, reasonable range. And the key to doing that is to only attempt to value businesses that are simple, predictable, and within what he famously calls his circle of competence. The story of his acquisition of See's Candies alongside his partner Charlie Munger is perhaps the most illuminating lesson in the art of a truly conservative and intelligent valuation. In 1972, Buffett and Munger were presented with the opportunity to buy See's Candies, a beloved family-owned chocolate company based in California. On the surface, it looked like a distinctly average business. It had modest assets, a few kitchens, a network of retail stores. It required capital to grow by opening new stores. The sellers were asking for $30 million, but Buffett and Munger, ever the bargain hunters, initially countered with a lower offer. Their initial valuation, based on the company's tangible assets and reported earnings, suggested the asking price was too high. They were thinking like classic cigar butt investors, looking for a discarded company that had one last good puff left in it for cheap. But Charlie Munger pushed Buffett to look deeper. He encouraged him to think not just about the numbers on the balance sheet, but about the intangible qualities of the business. See's Candies had something special, something that didn't show up in any accounting ledger. It had what Buffett would later call economic goodwill. For decades, See's had been building an incredible brand in the minds of its customers. People in California associated See's with quality, nostalgia, and special occasions. When a young man went to his girlfriend's house for the first time, he brought a box of See's. It was a part of the cultural fabric. This immense brand loyalty gave See's a powerful and durable competitive advantage: pricing power. Every year, after Christmas, the management could raise the price of their chocolates by a small amount, and customers wouldn't flinch. They weren't just buying chocolate, they were buying a trusted brand and the happy feelings associated with it. This meant the company could consistently grow its earnings without needing to invest huge amounts of new capital. It was a cash-generating machine. Buffett and Munger realized their initial valuation focused only on tangible assets was wrong. The true value of See's was in this powerful invisible moat. They reconsidered the business through this new lens. They conservatively estimated the future cash flows the business could generate, factoring in its ability to consistently raise prices. They ultimately agreed to buy the company for $25 million, a price that seemed expensive based on its book value, but was, in their revised estimation, incredibly cheap compared to its future earning power. See's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway over the subsequent decades, requiring very little additional capital investment. It taught Buffett a critical lesson. A wonderful business purchased at a fair price is far superior to a fair business purchased at a wonderful price. The valuation wasn't based on a complex spreadsheet. It was based on a simple, conservative understanding of a predictable business and its relationship with its customers. They could confidently predict that people would still be buying See's Candies in 10, 20, and 30 years, and they would be willing to pay a little more for it each year. That predictability was the key to a conservative valuation. The psychological principle at play here is a powerful defense against two common cognitive traps: the overconfidence effect and its close cousin, the Dunning-Kruger effect. The overconfidence effect is our tendency to be more confident in our own abilities and judgments than is objectively warranted. In investing, this manifests as a belief that we can predict the future of complex, rapidly changing industries like biotechnology, enterprise software, or advanced microchips. The Dunning-Kruger effect is a cognitive bias whereby people with low ability at a task overestimate their ability. Novice investors armed with a few online modeling tutorials often believe they have the tools to accurately value any company, no matter how complex. This leads them to create beautifully intricate discounted cash flow models for companies whose futures are fundamentally unknowable. They get a precise number like $173.24 and believe it's the truth when in reality it's a fantasy built on a mountain of speculative assumptions. Buffett's circle of competence is a direct antidote to this. By admitting what he doesn't know, he avoids these traps. He doesn't try to predict which pharmaceutical company will discover the next blockbuster drug. He doesn't try to guess which social media platform will dominate in 2035. He focuses on businesses like See's Candies, Coca-Cola, or Geico Insurance, businesses whose products and competitive positions are simple to understand and likely to endure. His valuations are conservative, precisely because the businesses themselves are predictable. This leads to the actionable blueprint for you, a mental model I call the 10-year test. Before you even begin to think about numbers or spreadsheets for a potential investment, you must subject it to this qualitative filter. First, grab a blank piece of paper and a pen. At the top, write the name of the company. Now, set a timer for 5 minutes. In those 5 minutes, you must be able to write down, with a high degree of confidence, a clear and simple description of what this business will likely look like in 10 years. Step 2 is to get specific. What will be its primary sources of revenue? Will they be the same as they are today? Who are its main competitors? And what will their position be relative to this company? Step 3 is the most crucial. You must clearly identify the company's durable competitive advantage, its moat. Is it a strong brand like Coca-Cola? A low-cost process like Geico? A network effect like American Express? Be specific. If you can't clearly articulate the moat, there probably isn't one. Step 4 is the final judgment. If you struggled to answer any of these questions, if your answers were filled with words like maybe, hopefully, or if they can, then the business fails the 10-year test. It is too difficult to value conservatively. You must put it in the too hard pile and move on, without regret. This filtering mechanism is the most important part of the valuation process. It ensures that you only spend your time analyzing businesses whose futures are reasonably predictable, making a conservative valuation possible. This is the essence of a sound, long-term investment strategy. The path of the 99% is to become what we can call the spreadsheet jockey. This individual does the exact opposite of the 10-year test. They find a company with an exciting story but an uncertain future, and then they build a spreadsheet to make the story look plausible. They project revenues growing at 30% per year for the next decade. They assume profit margins will expand dramatically as the company, quote, scales. They use a low discount rate to make future earnings seem more valuable today. They plug all these rosy assumptions into a complex model, and presto, the model spits out an intrinsic value that is far above the current stock price. They have used the spreadsheet not as a tool for conservative analysis, but as a machine for confirming their own biases. The fatal flaw is that their valuation is incredibly fragile. If you take their model and change the long-term growth assumption from 5% to 4%, the intrinsic value might plummet by 30%. Their feeling of precision is a complete illusion. They are precisely wrong. When reality inevitably falls short of their heroic projections, the stock price collapses, and they are left wondering what went wrong with their sophisticated stock market analysis. They valued a dream, not a business. The direct financial connection of mastering conservative valuation is its impact on your potential for capital gains. Investing is a game of probabilities. The goal is to find situations where the odds are heavily in your favor. By only valuing simple, predictable businesses, you increase the probability that your estimate of intrinsic value is, at the very least, in the right ballpark. By then being deliberately conservative in your assumptions, using modest growth rates and realistic profit margins, you are building a buffer directly into your valuation itself. This means your final estimate of value is a number you can genuinely rely on. When you later demand a discount to asterisk that conservative number, which is the next pillar, you are creating a situation of overwhelming odds. If you've valued a business at a conservative $100 per share and you buy it at $50, your upside is not just to $100. The true value might be $120 or $150. Your conservatism has created hidden leverage. This disciplined process of filtering for predictability and then valuing conservatively is what separates professional-level defensive investing from amateur speculation. It is the engine that generates high-probability, high-return opportunities, the essential building blocks for achieving long-term financial independence. It ensures that when you swing, you are swinging at a fat, slow pitch, right down the middle of the plate. We have now established the first two pillars. First, we must recognize that the market price is often a lie, and our true north is the intrinsic value of the business. Second, we have learned that the only reliable way to estimate that intrinsic value is to focus on simple, predictable businesses and to be ruthlessly conservative in our assumptions. But knowing what a business is worth is only half the battle. The crucial, final step, the one that activates the entire protective mechanism, is the third pillar, demanding the discount. This is the margin of safety in action. It is the ironclad discipline to not buy a business, no matter how wonderful it is, unless its price is significantly below your conservative calculation of its value. It is not enough to buy a dollar for a dollar. It is not even enough to buy a dollar for 95 cents. The essence of the strategy is to wait, patiently, for the opportunity to buy a dollar for 50 cents. This deep discount is your ultimate protection. It is the buffer that accounts for the fact that the future is uncertain, that you might have made a mistake in your analysis, or that just plain bad luck might strike. The 1973 investment in the Washington Post Company is Buffett's quintessential masterclass in the raw power of demanding a staggering discount. The early 1970s were a grim time for the stock market. The Nifty 50 era, a period where investors believed you could pay any price for a great growth stock, had come to a fiery end. Stocks like Polaroid and Xerox, once market darlings, had crashed spectacularly. The market was gripped by pessimism and malaise. It was a time of fear, and as we know, fear creates opportunity for the rational investor. The Washington Post Company was, at the time, a publicly traded but family-controlled media empire. Its crown jewel was, of course, the newspaper itself, a world-class institution fresh off its Pulitzer Prize-winning coverage of the Pentagon Papers and in the midst of breaking the Watergate scandal. But the company also owned Newsweek magazine, several profitable television stations, and other valuable media assets. On the stock market, however, the company was treated like an afterthought. Wall Street was out of love with newspaper stocks, and the entire market capitalization of the Washington Post Company had shrunk to a mere $80 million. Buffett, as always, ignored the market's mood and began his own analysis. He did what a private business owner would do. He valued the company piece by piece. He looked at what independent, private buyers were paying for television stations and newspapers in private market transactions. His conservative calculation was stunning. He concluded that the various assets of the company, if sold off separately, were worth somewhere between $400 million and $500 million. And yet, the stock market was offering him the chance to buy the entire collection of assets for just $80 million. He was being offered a $5 bill for $1. The margin of safety was enormous. It was the fat pitch he was born to swing at. Over the course of 1973, he invested nearly $11 million, acquiring a large stake in the company. He wasn't trying to time the bottom of the market. He was simply acting on the breathtaking discount between price and value. The market's pessimism provided the discount. His conservative valuation gave him the confidence to act. That initial $11 million investment would, over the next 3 decades, grow to be worth over $1.5 billion, a return of more than 100 to 1. It became one of the most successful investments of all time, a testament to the explosive power that is unlocked when a great business meets a massive margin of safety. The psychological principle that makes the margin of safety so powerful is its direct assault on our most potent and destructive financial emotion, loss aversion. Discovered by psychologists Daniel Kahneman and Amos Tversky, loss aversion is the tendency for our brains to feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. Losing $100 feels much worse than gaining $100 feels good. This is why market downturns are so terrifying for the average investor. When their stocks fall 10% or 20%, the pain centers in their brain light up, triggering a fight-or-flight response that often leads to panic selling at the worst possible time. The margin of safety is a psychological circuit breaker. It reframes the entire experience of a stock price decline. Imagine you have conservatively valued a stock at $100 and you bought it at $50. If the market panics and the stock drops to $40, your internal monologue is not, "Oh no, I'm losing money, the pain is unbearable." Instead, your rational framework takes over. Your thought process becomes, "I bought a business I believe is worth $100 for $50. The market is now offering it to me for $40. The margin of safety just got even wider. This is an even better opportunity than it was before." Volatility is transformed from a source of terror into a source of opportunity. This mental shift is, perhaps, the single greatest benefit of the entire strategy. It allows you to remain calm and rational when others are losing their minds, which is the precise moment when the greatest fortunes are made. The applied mental model for this pillar is brutally simple and effective. It's the 50-cent dollar bill rule. This is not a suggestion. It is a rigid, non-negotiable law for your investment operations. Step 1. You must complete the work of the previous pillar. You must have a conservative, defensible estimate of the intrinsic value per share for the business you are analyzing. Let's use our example of $100 per share. This number is the foundation of the entire process. Step 2. You must establish your required margin of safety as a fixed percentage. For true value investors following the Graham and Buffett tradition, this is typically between 30% and 50%. Let's be conservative and choose 50%. This is not a number you change based on how much you like a stock or how excited the market is. It is your system's prime directive. Step 3. You calculate your maximum buy price. In our example, it's the $100 intrinsic value minus the 50% margin of safety, which equals $50 per share. Step 4 is the execution, and it requires the discipline of a soldier. Your rule is now absolute. You do not buy the stock unless its price is at or below $50. You do not cheat and buy it at $52 because you're afraid of missing it. You do not get impatient and lower your margin of safety requirement to 40%. You set your price, and you wait. You can set a price alert with your broker and then go about your life. Most of the time, the price will never reach your target. That's fine. It means you have successfully avoided overpaying. But when it does hit, it's because some short-term fear or market dislocation has occurred, and you will be ready to act with supreme confidence. This rule-based approach removes emotion and forces patience, two of the most essential traits for any successful defensive investor. The antithesis of this disciplined approach is, of course, the path of the 99%, which is governed by the raw emotion of FOMO, the fear of missing out. The FOMO investor watches a popular stock run up. They see it on the news. They hear their friends at a barbecue bragging about how much money they've made on it. A primal fear begins to build, the fear of being left behind. They abandon any semblance of a rational process. They might tell themselves, "It's a great company, so it's probably worth the price." But they've done no independent valuation. They buy the stock at or near its all-time high, paying a fair price, or more often, a significant premium. They have no margin of safety. They are standing on a financial cliff edge with no railing. When the inevitable happens, a disappointing earnings report, a change in market sentiment, a general market downturn, the stock price falls. Because they have no buffer, they are immediately underwater. The pain of loss aversion kicks in, and they are faced with an agonizing decision: sell and lock in the loss, or hold on and pray it comes back. Often, they do the worst of both, holding on as the stock drops 30%, then panicking and selling, only to watch it recover later. Their entire journey was dictated by emotion, and the result is the permanent destruction of their hard-earned capital. The direct financial connection of demanding a discount is that it fundamentally re-engineers the risk-reward profile of your investments. Every professional in the world of high finance, from wealth management to private equity, is obsessed with the concept of risk-adjusted returns. It's not just about how much money you can make. It's about how much risk you took to make it. An investment that returns 15% with very little risk is infinitely superior to one that returns 20% but had a high chance of losing everything. The margin of safety is a powerful and elegant tool for maximizing risk-adjusted returns. By buying a stock at a 50% discount to its intrinsic value, you are simultaneously lowering your risk and increasing your potential return. The risk is lowered because the price has a long way to fall before you even reach its conservative value, giving you a massive cushion against unforeseen problems. The return is increased because, for the investment to simply return to its conservative intrinsic value, it must double in price. You have engineered a situation with limited downside and explosive upside. Over a lifetime of investing, systematically tilting the risk-reward equation so heavily in your favor is the surest path to beating the market. It is not about being a genius. It is about being a disciplined operator who refuses to play unless the odds are overwhelmingly stacked in their favor. This is the core of the CEO mindset applied to personal finance. You are the CEO of your own capital, and your primary job is capital preservation and intelligent allocation. Demanding a discount is your most powerful policy for executing that directive. We have now assembled the core mechanical components of Buffett's system. We understand the need to separate price from value, the art of conservative valuation, and the discipline of demanding a discount. But this entire system is designed to function within a chaotic and often irrational environment, the stock market. Therefore, the fourth pillar is a psychological one, understanding and exploiting the gap between price and value that is constantly being created by the predictable irrationality of human beings. The margin of safety isn't just a defensive tool, it's an offensive weapon that can only be deployed when the market serves up opportunities. And the market only serves up these opportunities because it is driven by the powerful primal emotions of fear and greed. Mastering this pillar is about learning to view market volatility not as a threat, but as the raw material from which fortunes are made. There is no greater example of this than Buffett's actions during the absolute vortex of fear that was the 2008 financial crisis. In the autumn of 2008, the global financial system was on the verge of collapse. Lehman Brothers, a 158-year-old institution, had vanished into bankruptcy. AIG, the world's largest insurer, had been bailed out. The credit markets were frozen solid. The headlines were apocalyptic. It felt, to many, like the end of capitalism itself. The stock market was in a freefall, and the financial sector was ground zero. Stocks of the most venerable institutions like Goldman Sachs and Bank of America were being sold with utter abandon. This was not reasoned analysis. It was a primal scream of terror. In this environment, 99.9% of people were thinking only of how to get their money out, how to flee to the perceived safety of cash or government bonds. Their brains were hijacked by fear. Warren Buffett, however, was thinking differently. On September 23, 2008, in the very heart of the storm, he announced a $5 billion investment in Goldman Sachs. A few weeks later, he penned a famous op-ed in the New York Times titled, "Buy American I Am." He stated clearly that he was moving his personal cash reserves into stocks. Then, as the crisis deepened, he would go on to make another multi-billion-dollar investment, this time in Bank of America. He was not trying to call the exact bottom of the market. In fact, after his investments, the market continued to fall for several more months. What he was doing was acting on the principles he had practiced for 50 years. He recognized that the price of these fundamental American institutions had become completely detached from their long-term value. Yes, they were in trouble, but with the full backing of the U.S. government, they were not going to disappear. He understood their long-term earning power, and the prices on offer were ludicrously cheap, providing a margin of safety of historic proportions. He acted because his psychological framework was built for this exact moment. While others saw only risk and terror, he saw once-in-a-generation bargains. His actions were a stark demonstration that the margin of safety is not just a calculation, it is a state of mind that allows you to be greedy when others are fearful. The psychological biases that create these epic opportunities are deeply rooted in our evolutionary wiring. One of the most powerful is the availability cascade. This is a self-reinforcing process where a collective belief gains more and more plausibility through its increasing repetition in public discourse. In 2008, the story was the financial system is collapsing. Every news report, every conversation, every market plunge reinforced this narrative. It became so available in our minds that it crowded out any rational, long-term analysis. We weren't evaluating balance sheets. We were reacting to the terrifying story being told over and over. Closely related is the affect heuristic, our tendency to let our emotions, in this case fear, drive our decisions. The feeling of panic becomes a substitute for thinking. The thought process is simple. I feel scared, therefore this is a bad situation. Therefore I must sell. It is a mental shortcut that is useful for escaping a predator on the savannah but is disastrous for financial decision-making. Buffett's entire investment philosophy is a system for overriding these primitive mental shortcuts. The rigid, analytical process of valuation and demanding a margin of safety acts as a rational anchor in a sea of emotional chaos. It allows him to replace the question, "How do I feel about the market?" with the question, "What is this business worth?" and "What price is the market offering me today?" The blueprint for cultivating this mindset comes directly from Buffett's own teacher, Benjamin Graham. It is the famous allegory of Mr. Market. Graham asks you to imagine that you are in a business partnership with a man named Mr. Market. Every day, without fail, Mr. Market comes to you and offers to either buy your share of the business or sell you his, at a specific price. The key is that Mr. Market is a manic depressive. Some days he is euphoric. He sees only a rosy future for your business and offers to buy your share at a ridiculously high price. Other days he is consumed by despair. He sees only trouble ahead and offers to sell you his share for pennies on the dollar. The critical insight is this: Mr. Market is there to serve you, not to guide you. You are free to ignore him completely. You should not be influenced by his mood swings. Your job is simply to take advantage of him when his offers are to your benefit. The applied mental model is to personify the stock market as this irrational partner. Step 1. Every morning when you look at the market, your first thought should not be, "Am I up or down?" but rather, "What is Mr. Market's mood today? Is he euphoric or is he terrified?" Step 2. You then compare his offered prices to your own private, rational calculation of intrinsic value. Step 3. If he is in a state of terror and is offering to sell you something for far less than you think it's worth, you should consider buying. If he is in a state of euphoria and is offering to buy your holdings at a price far above what you think they are worth, you should consider selling. On all other days when his prices are reasonable and uninteresting, you do nothing. You simply ignore him. This simple allegory is the most powerful tool ever devised for achieving the emotional detachment necessary for successful long-term investing. It transforms you from a passive victim of market volatility into an active and intelligent exploiter of it. This is how the retail investor can adopt a truly professional, CEO-level mindset. The antithesis to this approach is the market timer. This is the person who believes they can outsmart Mr. Market. They see the market falling and think, "I'll sell now and get back in at the bottom." The problem is that no one can consistently predict the bottom. So they sell after a significant drop, locking in a loss. Then they wait for the market to stabilize or for confirmation of a recovery. By the time they feel safe enough to get back in, the market has often recovered a significant portion of its losses, and they end up buying back in at a higher price than where they sold. They do the exact opposite of the Mr. Market model. They let his moods guide their actions, selling when he is fearful and buying when he becomes confident again. An even more common mistake is the investor who simply cannot handle the fear. They sell during a panic with no plan to get back in, converting a temporary paper loss into a permanent, devastating loss of capital. They let a single moment of Mr. Market's madness derail their entire long-term plan for financial independence. They become a casualty of their own psychology. The direct financial connection of mastering this psychological pillar is that it is the direct source of alpha, the financial term for returns that are above the market average. The market average, by definition, is the collective return of all participants. This average includes the panic sellers who sell at the bottom and the FOMO buyers who buy at the top. Their mistakes are baked into the average. Therefore, if you can systematically and unemotionally do the opposite, if you can be the one buying from the panic sellers and, perhaps, selling to the FOMO buyers, you are mathematically positioned to achieve returns that are superior to the average. It's not magic, it's arithmetic. The value investing strategy, fueled by the margin of safety, is a repeatable process for harvesting the profits created by the market's behavioral inefficiencies. When you buy a great business with a huge margin of safety during a market panic, you are essentially being paid to provide emotional stability to a system that has lost its mind. This is the ultimate source of beating the market over the long term. It is a robust investment strategy that doesn't just work in spite of market volatility. It requires market volatility to function. It turns the market's greatest weakness, its emotional instability, into your greatest strength. We have arrived at the final pillar, the one that ties everything together and reveals the true, explosive power of this seemingly defensive strategy. We've learned to separate price and value, to value businesses conservatively, to demand a deep discount, and to use market psychology to our advantage. But the ultimate goal of any investment strategy is not just to survive, but to grow your capital. The fifth pillar is the compounding engine. Understanding how the relentless focus on safety and capital preservation is, paradoxically, the most powerful engine for generating extraordinary long-term portfolio growth. The magic of compounding, what Einstein supposedly called the eighth wonder of the world, can only be unleashed if it is not interrupted. And the single biggest interruption to compounding is a large permanent loss. The margin of safety is, at its core, a mechanism designed to protect the compounding machine from ever being shut down. The story of Buffett's most famous investment, Coca-Cola, is less a story about a brilliant purchase and more a story about the wisdom of letting a safe investment compound for decades. In the aftermath of the Black Monday market crash of October 1987, the market was still jittery. By 1988, many stocks had recovered, but a general sense of caution remained. It was in this environment that Warren Buffett made one of the largest and most surprising moves of his career. He invested over $1 billion to acquire a 6.2% stake in the Coca-Cola Company. To many on Wall Street, this was a baffling move. Coca-Cola was already a massive, mature company. It was seen as an old economy stock, not a high-growth darling. Many thought its best days were behind it. But Buffett saw something different. He saw a business with one of the most powerful moats in the history of capitalism, its brand. The name Coca-Cola was instantly recognizable in virtually every country on Earth, representing a simple, consistent, and pleasurable experience. He also saw a brilliant distribution system and a business model that was incredibly capital light. But most importantly, he saw a massive untapped opportunity for international growth. At the time, per capita consumption of Coke products outside the United States was a tiny fraction of what it was domestically. He calculated, conservatively, the future earning power of the business as it expanded its global footprint. After the 1987 crash, the stock's price had become disconnected from this immense long-term value, offering him the margin of safety he required. The genius, however, was not just in the purchase. It was in what he did next. Almost nothing. He held the stock. He held it through the recession of the early 1990s. He held it through the dot-com bubble and its subsequent crash. He held it through the 2008 crisis. He understood that the initial margin of safety provided the protection, but the real money was to be made by letting the underlying business do its work, growing its earnings and dividends year after year, and allowing the miracle of compounding to take over. That $1 billion investment has since paid him billions upon billions in dividends alone, and the original stake is now worth well over $20 billion. The safety of the initial purchase gave him the conviction to hold for the long term, which is the only way to truly harness the power of compounding. The psychological bias that this pillar overcomes is one of the most subtle and pervasive: hyperbolic discounting. This is our brain's tendency to strongly prefer smaller, immediate rewards over larger, later rewards. It's why people choose to spend money today rather than save for retirement, and why investors are so tempted to do something with their portfolios. They want the immediate gratification of locking in a small gain or the thrill of chasing a hot stock. This creates a constant urge for activity: trading, churning, reallocating. But every time you sell a great business to lock in a profit, you interrupt the compounding process. You have to pay taxes on the gain, and you are now faced with the difficult task of finding an equally good investment. Buffett's approach is the ultimate antidote to this bias. The margin of safety gives you the confidence and psychological fortitude to sit still. Because you bought the business with such a buffer, you are not rattled by short-term market noise. This allows you to hold on for years, even decades, and let the eighth wonder of the world do its heavy lifting. It is a strategy built on the power of patience, a virtue that hyperbolic discounting makes incredibly rare. The applied mental model for this is what I call the portfolio pruning test. It's a way to ensure your portfolio remains a collection of high-conviction, long-term holdings, rather than a museum of past ideas. Once a quarter, you should perform this simple exercise. Look at every single stock you own. For each one, ask yourself this question: knowing what I know today, and based on its price today, would I be excited to buy this business right now with a sufficient margin of safety? This is a powerful and sometimes painful question. Too often, our portfolios are filled with stocks we wouldn't dream of buying at their current prices. We hold them either because we have a small gain we don't want to lose, or a small loss we are hoping to get back to even on. This is irrational. The portfolio pruning test forces you to view your portfolio not as a record of the past, but as a series of active decisions in the present. If a holding no longer passes the test, if you wouldn't buy it fresh today, it becomes a candidate for pruning. You can then reallocate that capital to one of your existing high-conviction ideas that pass the test, or hold it in cash, waiting for Mr. Market to offer you a new opportunity. This mental model shifts your focus from a flurry of pointless activity to the quiet, deliberate work of cultivating a garden of high-quality, attractively priced businesses, which is the ideal environment for long-term compounding and wealth creation. The path of the 99% is the path of the action junkie. This investor feels like they need to be constantly tinkering with their portfolio to justify their involvement. They buy and sell based on news headlines, analyst upgrades or downgrades, and tips from friends. They rack up huge costs in commissions and, more importantly, taxes. Every trade is a potential interruption of the compounding process. A close relative is the investor who practices diversification. They believe that owning hundreds of different stocks will make them safer. In reality, they have simply assembled a portfolio that is too complex to understand and is guaranteed to produce, at best, average results. They have no real conviction in any single holding and therefore no real margin of safety. They have diversified away their best ideas along with their worst. Both the action junkie and the diversifier share a common flaw. They mistake activity for progress. The Buffett approach understands that in long-term investing, progress is often measured by intelligent inaction. The most profitable move, most of the time, is to do nothing at all. Finally, we come to the direct financial connection, the mathematical certainty that underpins this entire pillar. The most important rule of compounding is that the numbers are not symmetrical. If you have $100 and you lose 50%, you are left with $50. To get back to your starting point of $100, you don't need a 50% gain. You need a 100% gain. A single large loss sets you back exponentially. Therefore, the most efficient and reliable path to building wealth is not necessarily to pick the stock that goes up the most, but to ruthlessly avoid the stocks that can cause a catastrophic loss. The margin of safety is a systematic, mathematical tool for loss avoidance. By building a massive buffer into every single purchase, you are dramatically reducing the probability of ever suffering that 50% loss from which it is so difficult to recover. By keeping the left side of your financial ledger, the losses, as close to zero as possible, the right side, the gains, will take care of itself through the relentless upward march of the earning power of great businesses and the inescapable force of compound interest. This is the ultimate secret of the Warren Buffett strategy. It is a system where capital preservation is not in opposition to portfolio growth, but is its most critical ingredient. The promise of not losing money is the final promise because it is the only one that makes all other financial goals, building wealth, achieving financial freedom, securing your future, not just possible, but probable. You have just spent your time acquiring a complete mental framework. This isn't just a tip or a tactic. It is a robust, all-weather operating system for making financial decisions under pressure. You now possess the foundational principle that Warren Buffett has used to protect and compound capital through every imaginable market environment for over 60 years. You understand that the key to winning is not to focus on winning, but to focus, with an almost religious intensity, on not losing. By building a margin of safety into every decision, you have learned how to create a protective buffer that shields you from bad luck, from your own analytical errors, and from the emotional madness of the crowd. This is a profound shift in perspective, one that moves you from being a passenger at the mercy of the market's whims to being the pilot, calmly navigating with a proven system. But it is crucial to understand that this is one part, the most important part, the foundation, of a larger, interconnected network of mental models. The margin of safety is your shield. It tells you, when to buy. But it is most powerful when paired with the knowledge of what a buy. The ability to identify a truly wonderful business, one with a durable competitive advantage, or moat, is the other half of the equation. Valuing a mediocre business and buying it cheap can be profitable, but valuing a truly great business and buying it at a fair price with a margin of safety is how generational wealth is built. The video that is now on your screen is designed to be the next piece of that map. It is the vital link that connects the defensive shield of the margin of safety with the offensive weapon of selecting world-class companies. It illuminates the very characteristics that make a business worth valuing in the first place. The journey to becoming a truly intelligent investor is a process of assembling this complete mental arsenal. You have just forged the shield. The question now is whether you will stop there, or whether you will continue on to forge the sword. The choice to click is not just about watching another video. It is a decision about what kind of investor you choose to be. Will you be someone who has one powerful tool, or will you be the operator who has mastered the entire system? The map to completing your arsenal is right there. The journey continues.